Rolling closing costs into the loan. Common question, get it a lot. My friend rolled closing costs into the loan. Let's technically talk about what's happening there. There's two ways to do it, because again, there's a lot of compliance that that centers around money with regards to buyers and sellers of homes, mortgage applications. There's a lot of regulations. So there's really two technical ways that you can roll closing costs into the purchase of a new home. First way is you may offer with your offer to the seller, you may request a seller concession toward closing costs and prepaid escrows at the time of your offer. Just remember that the seller is going to view the sales price offered minus the seller concession to closing costs and or prepaid items and review the net result of that as what you're really going to pay them for the home. If it's marketable versus your other competition, they're likely to accept it. There are some rules depending on how much down payment you're doing on the financing of how much you can request. It can never exceed the total of the closing costs, state tax stamps if applicable in the state that you're purchasing, and the prepaid items. It can never exceed that. In certain cases, it can't exceed 3% of the sales price. In certain cases, it can't exceed 2% of the sales price. So you want to watch those rules. Your realtor might know them. Your mortgage professional will definitely know them. So bring it up during your qualification if you're thinking about using that. The second way to do it would be what's called, the lender calls it premium pricing. So that's typically kind of the inside phrase of how they think about it. But it works pretty simple. Typically, when you apply for a mortgage, the lender's going to give you a few different options. There might be a rate where you pay 2 discount points, and that rate is lower than the next option, which might be a rate with 1 discount point. So rate's a little higher, but you paid 1 discount point versus 2. A discount point is defined as 1%. A single discount point is 1% of the loan amount added to the closing costs at the time of acquiring the loan as prepaid interest, and the lender uses it to be able to receive some interest on that loan early, in which case they can give you a slightly lower rate over time versus a loan that has 0 discount points paid. So understanding that, you could go to a situation where you say to the lender, do you have an option where you can give a 1% lender credit where I pay you a higher rate over time to make up for that? It's still the same cost of funds to the lender. And so within that, they can say, okay, we can give you a credit, so some money now towards your closing costs, escrows, state tax stamps, for which you're going to pay a slightly higher rate over time. And there's a lot of cases where that's very valuable to the home buyer, even though they're going to pay a slightly higher rate over time, because they're getting that money early, which is going to enable them to stop renting early where they're just burning their money on rent with no return. Here, they're going to be able to enter the home ownership market earlier. And another place where it's going to help is where a borrower might be leaving, knowing that this is a short-term property for them. They know it's a 2-year commitment on a job in an area they don't want to rent. They want to purchase. They want to minimize their cost of ownership over that 2.5-3 year time horizon. In that case, going with a slightly higher rate that allows them to receive a lender credit at closing, allowing them to keep some of their cash, can be valuable when you look at the difference in monthly payment over that 24 to 30 months versus the lender credit that they received at the beginning. They might end up ahead that their total cost of ownership over that 24 to 36 months might be less going with the higher rate but getting the lender credit. So that's a summary of rolling closing costs into the loan.